We have Saurabh Mukherjee joining us now to talk more about markets and his portfolio approach. Saurabh, first of all, where have you been? Long time. Have you been traveling, busy building your business, or quietly approaching the markets, sitting with your team in Powai? Long time.
Thanks, very good to see you. Yes, I've been doing a fair bit of traveling in the Western world. As you can imagine, there's plenty of foreign investor interest, and given the length of the elections and the complexity of the political landscape, both our existing clients in the Western world and prospective clients wanted to spend time. So I spent a good 2.5 weeks on the road, traveling around Europe and America.
Good. Tell us, what exactly were the conversations like when you were sitting, far away from India, but looking at India from the foreign lens in conversation with some of your prospective clients? What were they asking you, probing you? What are they most curious about?
So let me break it into three parts. Obviously, the first discussion tends to be election में क्या होगा, क्या लगता है, and my response is I really don't know. You can read the newspapers as well as anybody else can. I tell my clients. And the simple point of view on that is, regardless of what happens in the election, it looks like there will be policy continuity. There'll probably be governance continuity as well, but almost certainly there'll be policy continuity. And hence my point of view to the foreign investors is, beyond a point, don't you shouldn't overemphasize the elections. We've been through a variety of political dispensations in the last 3 decades, and growth has been in the 6-7%, 6-7% area. India rarely grows much faster than 7% and rarely grows much slower than 6%. So I try to persuade people not to overemphasize the politics. But I have to admit, it is hard. Most foreign investors, pension funds, endowments tend to agonize endlessly about what will happen on 4th June. The second discussion tends to be around valuations, right? And the point of view generally in the Western world is India is महंगा, India में valuations ज़्यादा है, and our point of view is, compare it to America. The Indian, especially high quality Indian stocks of the sort we like, Ajay, high quality Indian stocks, the valuation multiples relative to the growth they can generate are significantly lower than the S&P 500, and that maths is easy to provide. And I think most American investors I met understood that point, that if you look at the S&P 500 relative to where it stands on valuations relative to the growth that the S&P delivers in earnings, the quality Indian names that we like, the HDFC banks, the Asian Paints, the Bajaj Finances, this is actually one of the most delicious valuation junctures that you will find. And therefore, I think that was a more or less constructive discussion, that if you want to buy Indian quality, this is the juncture to do it, when we've had 2 years of run up in low quality names. And the third discussion tends to be what's happening to consumption. Why do you have such a pronounced weakness in consumption? 2% consumption growth for a relatively poor country is quite unprecedented, and therefore there tends to be a degree of concern as to how prolonged, how extended will be the consumption slowdown in India. And there, my submission to foreign investors is, whichever government comes in after the elections, the first budget, the union budget in July, I'm sure will contain steps to both boost employment and drive consumption up.
So, you made a very valid point about the growth, the range, irrespective of political leadership, we have managed that growth. But what was your answer to your, friends and prospective clients regarding the valuation argument? Because that is something which is being hectically discussed here back home in India as well.
Sure. So if you take trailing P, and let me just use trailing P because it's easier to explain. If you look on trailing P, the sorts of stocks we buy. So we'll take the consistent compounders, for example. That's the large cap portfolio that we offer to our clients. Consistent compounders was at around 35 times trailing 5 years ago, Ajay. And when we started the firm in 2018, 6 years ago, when we started the firm, consistent compounders was around on 35 times. By the time we got to Feb 2022, that had run up to 50 times, right? So over the course of those 2 waves of COVID and the Federal Reserve's $10 trillion stimulus, consistent compounded has this rocket-fueled re-rating from 35 times to 50 times. And then it derated. It derated steadily. Earnings compounding continued, but the share prices came off. And CCP, therefore, is back to 35 times earnings. So over a 6-year time frame, Ajay, we've done a proper round trip on CCP trailing PE from 35 up to 50 and back to 35. Now, what are you getting if you pay? Just to keep it simple, if you pay 35 times, आपको क्या मिल रहा है? What is the growth that you're able to buy? These companies, EPS is compounded over the last 3 years, 5 years, 10 years at roughly 20-25%. So if you're paying 35 times earnings for 2020, if you're paying 35 times earnings for 20-25% growth, that's a very attractive PEG, as the Americans like to call it. The PEG here is coming to 1.3, 1.4. In contrast, if you look at the S&P 500 today, S&P 500 on trailing is pushing 24, 25, and S&P 500 EPS growth is around 15%. So S&P 500 is actually closer to 2 times on PEG, whereas high quality Indian compounders of the sort we like are closer to 1.4, 1.5. So the fact that the sorts of names we like, some of the names they're showing on the screen, other names would be an Asian Paints, a Divi's Lab, a Dr. Lal Path Labs. The fact that the sorts of names we like are available at better valuations than the S&P 500 is something that I think resonates with fair few foreigners, and hopefully post 4th of June, that will translate into inflows into the Indian market.
Saurabh, tell us what kind of changes have the team been making in your portfolios lately? If you can, just share for indicative purposes, only for education purposes, some additions and deletions you have done and why.
Sure. So in consistent compounders over the last 6 months, we have increased the Trent allocation. Trent did well for us. We increased it. It's ripped through so aggressively that we are thinking of pairing back on Trent a fair bit. We started on Trent in July last year. It's, I think, trebled on us since July last year. We've also added Tube investments over the last 6 months. The reason we like Tube is not just the CG Power story and remarkable turnaround there by the Murugappa Group, but we also like CG for the fact that the EV initiatives that they're pursuing, the clean mobility subsidiary that they have built, TI Clean Mobility. We think there's plenty of potential there in their EV two-wheelers, their EV trucks, and the EV three-wheeler business that they've put together. In addition, the Shanti Gears business is a small part of the Tube franchise, but I think Shanti Gears in Gears is on its way to building the preeminent gears business in the country. We've also added Eicher Motors to consistent compounders. Eicher Motors was in our mid-cap portfolio for a couple of years, but having seen how Siddharth Lal has systematically built this franchise over the last 15 years, and specifically in the last 5 years, strengthened the export potential of the Eicher franchise, bought in more bikes, bought in premium bikes at the 600cc level, and bought in a 250cc bike with better price points than Eicher used to historically give. We think he's built plenty of optionality here. The ECV business, the Volvo Eicher business, is also doing very well for Eicher Motors. There are a couple of other additions that are underway in CCP. I'm not at liberty to talk about them, but CCP has basically seen a 1/3 of the portfolio has been overhauled over the last 12 months as we try to lock into the new growth engines that the country has in the form of industrial manufacturing and in the form of potentially the potential revival of the retail space. As I said, the consumption piece has been weak in India now for the last 2 years, and I strongly believe that whatever happens on 4th June, we will see a very pro-consumption budget in July. It'll be very difficult for whoever is in charge of the country not to push through a pro-consumption budget in July. The consumption weakness is so evident in the GDP numbers that I reckon there'll be a consumption revival, and therefore we're looking for some retail names that can help us juice up the consumption piece over and above what Trent has already done for us. In small and mid cap, in the last 6 months, we've added names such as Eureka Forbes. We've added RHI Magnesita around 8-9 months ago. We continue to believe that there will be a private sector capex revival. The government capex revival obviously is well understood, but I think there's also a private sector capex revival underway, and names like SKF, not SRF, SKF should help us benefit from that. SKF's had a rocket fueled rally since we loaded up on it a few months ago, and courtesy the run up in valuations, we had to pare back a bit. But the private sector capex revival through SKF, through Shanti Gears, through RHI Magnus Gear, through Tega. We are trying to capitalize on that. One disclaimer to everybody who's listening. I'm an investor in Marcellus's products. Naturally, I have a beneficial interest in this. So are my parents, and obviously, so are our 8,000 clients.
Thanks very much for that disclosure as well, Saurabh. Would have loved to chat more, but very short on time because of so many earnings. But we will schedule a longer chat with you very soon. We'll take a short break on that note to come back and put the spotlight on Aadhaar housing. The numbers are out after the recent listing. We'll be speaking with the management right after this break.